Hey, let's do the monthly walkthrough on this restoration company. They do about 12 million a year in revenue and have 40-ish employees, 41 I think it is. So here we have their three bottom lines. So first, net profit. This one I think owners are most used to looking at. That's at the bottom of the P&L, your net profit number. And so they have made money this month, only about half as much as last month, but still that is a decent net profit. The operating cash flow is in the negative this month, however, so that is not a great sign. It looks like last month, though, they brought in a lot of cash, so that is reassuring that they probably have some amount stockpiled in the bank to cover this. So we will look later at how, if they had net profit, how did they end up with less money in the bank at the end of the month? That is always a mystery, and we'll go figure it out. And then the return on assets is 3%, which isn't too bad at all. This is, we track this closely so that we can see, is this a valuable place to be putting the owner's time and resources? Because if they could get a higher return on assets by having their money in real estate or in, the market, or then maybe this isn't an excellent use of all their time and resources. So we try to keep an eye on this and keep it in perspective and make sure that we're doing everything we can to optimize that number. So those are our three biggest numbers that we look for. Okay, sales. How much did we earn and where did it come from? So our total revenue was $975,000. We are newer with this company tracking this data, so these graphs look a little bit short temporarily here. So last month was a banner month as far as revenue and also profit, I believe. So we still are above where we were in January. In general, we are where we need to be, although compared to last month, it's not as high. I believe that they had an ice event last month. So let's look at our revenue breakdown. So we have mitigation, which is our number one, rebuild, mold mitigation, and contents. Here's a graph showing the same thing. Our job category totals. So how many jobs we had in each of these segments. So our mitigation jobs are up again at the end of this month. And then the rest of the categories are pretty close together. Our average dollar per job, we had a big spike of recon job value last month, and now we're back to about where we were in January. So our profit drivers, so our operating profit was $201,000, which is great. It'll be just slightly more than our net profit. It's different than our net profit because our operating profit doesn't take into account a few different financing and investing activities that may be done. So operating profit really is the number that truly shows what did we make from just our business operations, just those, in this case, water restoration, mitigation, those activities. So total new jobs, 127. Average job value is pretty decent. It's down from last month, $7,600. Our labor percentage is at 28%. It's up significantly from last month, but last month, I believe that there was a decent amount of subcontractor labor in there. Things, because last month was a banner month, it was a bit unusual. So 28% is still okay for this company. I was talking with someone today, it varies greatly. Where we want this percentage to be, it's nice to have an industry-wide number or something like that. 30 or 35% get thrown around as what's right for this industry. In general, as a generality, that's great. But it really matters what is your mix of in-house versus subcontracted labor. Subcontracted labor, they're carrying their own overhead. So if it ends up being a little bit higher, it might be okay, conditionally. It matters too, your mix of mitigation versus rebuild. There's a whole lot of things, a whole lot of factors we have to take into account when we're deciding what that should be, because that's different for every company and every scenario. And it's even different month to month if the mix changes. So here we have our COGS percentage. So that includes the labor and then also adds in things like materials, supplies, dump fees, testing, things like that. We want that to be ideally 40% or less. So 44 is a little high. Last month it looks like they must have been at 41, which was already pretty borderline, and it's creeping up a bit here. So we're going to keep an eye on that, certainly. Marketing 6% is about what we would expect to see. Overhead being 36 is good. We would want it to be below 40. And it's nice, at least, that put together these still are getting us to the 80 that it would be. It's nice that overhead is a little bit low right now. Lower, so that it offsets the fact that COGS is a little bit higher. So what's left over? So we have our gross profit, which is what's left after we take out all of our COGS expenses. We have our operating profit, which is what's left after we also take out all of the overhead expenses. And our operating profit margin is at 20% and higher, which is what we want to see. Our net profit also remains at 20, which is great. If we can walk away with 20% on paper profit, then we have enough money left over that we should be able to pay our principal balances on our loans and do some investing in new equipment or vehicles, be saving for that type of activity. So just because there's 20% of profit, it doesn't mean you're done paying for keeping the company operational. So we want a healthy chunk there, not because the owner gets to walk away with all of it, but because we need other expenses, other things to get paid before we actually get to keep that cash. So we want to keep that at 20 if we can. Our profit margin. So our gross profit margin is down a tiny bit. We want to keep that right at 60 or above if possible. But hopefully we can reverse the decline by next month. Same thing here. We're still staying right above 20, which is fantastic. Last month, like I said, they had a really profitable month, which was great. What did we earn from operations this month? So here we just have our P&L statement. So we have our revenue, and then we have our cost of goods sold, and all of our expense categories. That gets us to our net income and our net margin. So these charts are a bit short, again, because we've only been tracking this for 3 months here with these guys. But here we have our net profit, and then these are the assets. So the only big change here is the amount of cash in the bank is down. And we saw that that was going to be the case when we looked at our operating cash flow earlier. And that's where it shows up. Other than that, our assets have stayed pretty stable. Our return on assets is down. That is our profit basically divided by our assets. And so because our profit is down, our assets are down. Our return on assets is down, excuse me. Cash on hand also. We have a decent stockpile. That being said, we're trending downwards. We want to keep an eye on that. Whoever is paying the bills is probably starting to feel that decline a bit. Efficiency. Did we deliver efficiently, and are we optimizing our operations? So our revenue per tech here is 51,000. So that's pretty good. Revenue per admin, I would prefer if it was a little bit higher. Probably it could be a little higher. I imagine if they have more work come in, they would be able to handle a bit more. So that's something to keep an eye on when you're adding more overhead positions. Keeping an eye on that number helps guide you as to what is reasonable and when they may need more backup. Job acquisition cost of $485. If we had mostly little jobs, that would be concerningly high. But the fact that our average job cost was, I think it was $6,800, then that 485 doesn't bother me too much. What we received and what we spent. So here's the breakdown. Labor is our biggest money outflow by far, and then subcontractor expense, and then payroll taxes. So all three of those are in our labor percentage. And then same thing over here, our salaries for our admin. So labor is by far our biggest expense in restoration, and everything else here looks pretty reasonable and like I would expect to see it for these guys. So I'm happy with that. Let's see what else we have here. Here's our income statement, showing the percentages, our common size income statement. So it's showing labor percent. So if we can keep an eye on here of these different expenses, so that if they're creeping up, we can figure out if that's telling us something we need to know. Our expenditure mix. So we have our COGS, our fixed expenses, and our operating profit. So that's about what we'd like to see. Okay, so now we get into why did we lose cash if we were profitable? What's happening there? So our cash flow drivers. So our operating cash flow, we have $140,000 less in the bank than we had the month previous, the end of the month previous. These meetings, of course, take place a week or two after the close of the month. So by now, they may have recovered. But this is the snapshot of the last day of the month. Okay, so our accounts payable days are actually nice and high, which helps our cash flow. We want to pay our bills as late as possible without it backfiring on us. So we enjoy that number is high. Ideally, we want that number to be higher than the accounts receivable days so that we aren't having to cover that difference in cash flow as the owner, but instead we're getting our cash in before we have to pay the expenses on our jobs. As businesses grow, the cash flow gap there ends up being a large problem that the owners are having to cover more and more of the cash, whether personally or getting a loan. But it's fantastic when you can get the money in from your new, bigger, more jobs, and then that can cover the expenses. But it's hard to arrange that often. So these guys are doing a great job in that department. So this is where that 140,000, it is because of this, basically. We paid an extra $200,000 in payables more than we had the previous month. So we paid a lot of bills, and that's where that cash all went out to the door going toward. And in fact, we made gains in other areas because we're only down 140,000. We paid 200,000 out. Okay, accounts receivable days. This is really high. So we need to look at collections really closely and see what caused this big jump, 32-day jump since last month. So that is something that we really need to be looking at, how to get that down. We want that at 45 days or less if we can arrange it. So we'll look into that more closely. Our accounts receivable decreased. Our accounts receivable increased $140,000. So we put more into AR. We started more jobs, did more work than we actually brought money in. So that's not going to help cash flow. So our revenue growth rate is down, but we know that because last month was a banner month. Our AR growth rate is up a bit. Not too high, but we need to get those AR days down. That's the critical part. So it looks like this company is averaging really high AR days. So we need to get collections fixed. Last month, it looks like they did have a chunk of money come in, which brought it down for a while. But that is the biggest issue I'm seeing here. None of this is too notable. The owner didn't put any money in or out this month. We repaid $9,000 of principal. And so that's how our net cash flow ended up negative. It's a combo of those events. So this kind of spells out in a visual what happened. So we had our revenue come in, got us up to almost $1 million. And then our cost of goods sold took up this $425,000. Then our expenses cost this. Our changes in accounts payable, all that extra money, all those bills getting paid, that money going out is what brought us to pretty much neutral. And then the fact that we have money added to AR took us even further. So, and then not much happened in the investing and financing areas. So basically, it's the change in accounts payable and the change in AR can have a huge impact as far as how much cash you have in the bank. And that sort of happens not on the surface as much. If you're out there in the field and we're profitable, we're doing good work, we're making money, hypothetically, making money on paper, that's great and all, but oftentimes what the office departments are doing, collections and whoever's paying the bills, what they're doing has an enormous impact on cash that goes unseen until it's very obvious by the bank balance. So we try to help keep an eye on that. What we owe, here's our liabilities. Our accounts payable is down from the previous month, which we know. That's the benefit that we got from that $200,000 in cash going out the door. So it's a good thing, except for cash flow. So what's ahead? So this is based on their revenue. So we have their baseline revenue forecast set up, and then we also have a forecasting that they are going to add another vehicle and 2 technicians in a few months. And so that is taken into account here. And so here's where we are at in our actuals this month. And then this is what our forecast is expecting to see. And we will keep adjusting that as we go along. Our operating profit scenario, we're expecting to have a steady increase. And again, we will be checking to see if this is accurate as we go along. We update with the actuals over the top, and then it readjusts. Our growth analysis, so this chart is real short, but we had a lot of positive growth in February over January, and then in March, of course, we are down from where we were in February. That said, these numbers look very scary, but that said, February was a banner month, so we're not worried about this yet. It is not a new trend yet. What portion of revenue turns into usable cash? So here we have our EBITDA number on the side, which is our earnings before interest and tax. So that's our operating profit, like we talked about before. And then our investment is across the bottom. So we love that we are entirely in this quality growth area. Efficiency gains isn't actually a bad thing either, but we definitely don't want to be down in decline and stress. And they are not, but we're hoping next month will look slightly better so we can break this downward trend. And our break-even analysis. So this is really helpful, and it helps to even convey the concept to your people that are in the field, because every extra dollar that you get at revenue makes a huge impact on the bottom line, every extra bonus dollar. So for example, the first money that comes in the door needs to conceptually cover your fixed costs, your expenses, your overhead, basically. The overhead that you're paying whether you do any work or not. So that gets covered first. Then we have our variable costs, which are the costs of literally doing the jobs. So that COGS number. And then the revenue is above and beyond that. Well, at the point that we've covered our fixed costs and then we've added our variable costs on, after the fixed costs are gone, the variable costs for any additional work only takes 44 cents, and we'd like it to be 40. It's being done at the 40%, but it's taking 44 cents per dollar, which means any additional work that can be done on site, you get to keep 56 cents on every dollar. So that starts to add up at the bottom line really faster than that early set of work where you're covering your overhead. So for water restoration, it's as simple as making sure you have every single air mover on the job that belongs there. Making sure that you aren't missing things that should be billed to the job. Those little 3% at the end of the day, it goes entirely to your bottom line. So it makes a huge difference. So that is where we are at for this month. I think in general they're doing well. I'm going to check in on collections, definitely. And then we will be looking next month to see that the revenue has gone up a bit, hopefully, and that our labor percentage and our cost of goods is back under 40, ideally. Let me know if you want me to look through and help with your business. I would be delighted to. You can go check us out at kiwicashflow.com.